Thanks for tuning in to this episode of the Resilient Advisor Show. My name is Jay Coulter, and joining me for this episode is my friend Kevin Simpson, and we're going to talk about the markets, the economy, and covered call writing in the first quarter of 2021. For those that do not know Kevin, he is the founder and chief investment officer at Capital Wealth Planning, a manager of SMAs and the ETF DIVO. Kevin, you're always such an entertaining guest. I was very fortunate earlier this week. I got to help you co-host an event with the great Gary Kaminsky at the Raymond James Conference. Tell me, what were your takeaways from the opportunity we had to spend time with Gary Kaminsky?
Well, first of all, Jay, thank goodness that you were the moderator for that, because left to our own devices, allowing Gary and I to talk probably would have been a 4-hour conference for the poor attendees as opposed to the 40 minutes that we had scheduled. So your professionalism and keeping us on track made it a phenomenal event. I think the biggest takeaway for me, and first of all, it was a huge treat just to be able to hear some of these stories, pull the curtain back and see some of these great tales and get firsthand knowledge on not only Wall Street, but also CNBC. But the takeaway is that the more things change, the more they stay the same. After we were finished talking, we went through almost this incredible recent history of stock market corrections. We talked about 87. We talked about 99 into 2000. We talked about 2002. We certainly spent a lot of time talking about the financial crisis of 2008, 2009, and how that compared to 2020 in the first half of the year. And I think looking ahead, it becomes a situation where the more of these you live through, you never like them, they're never pleasant, but the more capable you are as a portfolio manager when they do happen. And we don't know what the next correction will be or what the catalyst will be that causes it, but we think we know how to best navigate it.
Yeah. Kevin, that was my exact takeaway as well. The more things change, the more they stay the same. And people that are proactive with their portfolios in their risk management tend to have better outcomes as you go through a crisis. So for those of you watching live on Twitter, LinkedIn, Facebook, or YouTube, if you'd like to ask a question, simply type it in the comment section, and somehow this studio pushes it through to me, and I will pose it to Kevin. And I've also got to congratulate you, Kevin. You're new to Twitter, a new handle at Covered Calls. You've been on for not more than a week and a half, 2 weeks. What do you think so far of the mayhem that is Twitter?
Well, we had to wait 4 years for Covered Calls to have that handle open up. So finding that available made it very easy to get on. I think my only 2 followers are you and someone from your staff. So we're excited about your negative feedback being kept to a minimum. But what a delayed entry for someone who's in this industry to get associated with it. But we're excited. We're seeing some really neat interaction with it, and I think that's what it's all about. The more you can interact, the more you can be educated. I think I learned just as much from it as I can teach, and hopefully we'll have continued success and maybe more than 2 followers. Who knows?
You're well beyond 2 followers. And the reason I had to encourage Kevin to get on Twitter is, he's both educating and entertaining. And it's your laid back, humble style when you talk about portfolio construction and investments that I think will make you a hit on Twitter. Follow him at Covered Calls if you are on Twitter. And another reason to get on Twitter for Kevin was that he launched a new show, The Kevin Simpson Show. We produced our first episode with Jeff Saut last week. And I want to play a clip for my first question for you, Kevin. And this is around how you'd allocate $1 million today.
I think you break it into 4 tranches of $250,000, and you commit the first tranche, this week or next week, but you commit it. Because if you sit back and try and wait for an exact timing point, investors, to a large degree, will never commit the money. And then you step back and you wait and see what the market does, and somewhere down the road you commit the next tranche, and then the next tranche, and then the next tranche.
Jeff is always entertaining. That's not unsound advice. What's your take? Because this is one of the biggest challenges financial advisors have today. What do you do with new money?
Yeah, and I think, listening to Jeff talk about that, it's a sentiment that I would echo completely. Especially today, we're looking at markets that are experiencing a little bit of weakness. I imagine that there's been reason technically for some pullbacks here over the next short term. Still very, very bullish over the long term in the second half of the year, but a little bit more cautious here as of late than we've been in some time. So layering money in is never a bad idea. It's so difficult to be able to time the market. It's even harder to time the market effectively and consistently. I could make a strong argument that it's pretty much impossible. So utilizing an old-fashioned dollar cost averaging, layering in approach to high quality investment ideas, allocations, portfolios is an old-fashioned idea that will never go out of style.
You can never go wrong with dollar cost averaging. So
unless the market goes up 10,000 points tomorrow, Jay, in which case you were an idiot for not letting us put it all to work.
Yeah,
but the probability of that's
not, right. You're an idiot for that window until it drops back down and you can get back in at a lower price. Yeah, you know what's more disturbing? Now that I'm playing clips and I'm in that clip, I'm wearing the exact same thing. At some point, I'm going to get exposed for wearing the same thing for every episode.
Are you wearing pants, Jay?
Sometimes.
A little too personal, right?
All right, next question. I loved your Monday morning observations note. So we're recording this on Thursday. On Monday, you talked about one of the positives looking forward was the upward trend of the 10-year at the time at 1.34%. Today, we're touching 1.5. Has your thoughts changed in 4 days given that dramatic increase? Or do you think we should take a different lens on the 10-year at this stage?
No, I typically don't get too worked up over a 2 or 3 day swing on anything, but the impressive move. I mean, think about where the 10-year was just 6-9 months ago. Going from basically a half a point up to 1.5 is a massive rally. And on a percentage basis, it's like, oh my gosh, look what just happened. And it does tighten the yield curve a little bit. And I prefer to see it probably where we were last Friday as opposed to this Thursday. But again, a few days don't make a market. But putting that in perspective and taking a step back, if there's only one thing that you take away from my comments, it's that even at 1.5% or 1.75 or 2%, historically, that is such a low bar for the 10-year that it's definitely not something that's going to cause tremendous alarm for me, for my team, or for our portfolio. We're seeing some weakness today, and I think the volatility that we saw last week is here for the short term, for the duration as we work through some of these things, and definitely it's a surprise it was a surprise to see it at a half a point, and it'll be a surprise to see it at 2% over that short period of time. But it doesn't change the thesis of our long-term bullish outlook on equities.
All right, so let's take this opportunity to go a little bit deeper in your portfolio. So interest rates are rising here in the first quarter. What are the implications in a covered call SMA portfolio as it relates to building it out for new money?
Yeah, I think the interest rates have a lot less to do with the actual covered call component. If anything, it's been leading to more volatility, and that helps covered call writing. I'm always repeating this comment that covered calls work best when we need them to most, which is in periods of uncertainties, scary markets, higher volatility. And anytime we see an inflated VIX, higher volatility, it's going to bode well for the premiums that we're generating when we're writing covered calls. So it does work, I think, to our advantage. That being said, it has a bigger impact, I think, longer term than over the short term, and maybe even more so with certain stocks and certain names that we own, irrespective of the covered call writing. But drilling down into the dividends, high dividend names are interest rate sensitive. For that reason, we have a portfolio that's based on dividend growth, which is a little bit less involved with the day-to-day fluctuations of rising interest rates. Doesn't mean it doesn't affect it, but I think it has less of an effect on a rising dividend portfolio than a high dividend portfolio.
Well, first, I want to congratulate you for that awesome pivot when I asked you a question about the 10-year, which did not matter to you, and the volatility does matter, and to work that in, you are a media pro. I appreciate you bailing me out on that one because that was a bad question.
It was a great observation, and I think all of us are sitting here looking at the yield curves and looking at 10-year interest rates and wondering at what point is that yield too high? You know, we don't want to see high interest rates if we're worried about the stock markets. So I applaud you for keeping an eye on it, and I think we all should.
Let's talk about what's on everybody's mind. GME.
What's that, Jay?
What do you say to the advisors when they call? Because I know you speak to countless advisors every day, just like I do. And it's not that they want to invest in it. It's that their clients do. And short of saying, tell your clients not to be idiots, tell me, what do you make of the nonsense that's going on with GME?
So I don't have time to follow it as closely as I would like. I mean, I think it's a tremendous revolution and just a wonderful thing that people are becoming so interested in the stock market, so involved in the stock market. So to the extent that there's a Reddit crowd and that young people are communicating and talking about any type of investment in the stock market, whether it's a GameStop position that I might not completely understand, or it's Bitcoin that may be in that same category I don't completely understand. But just having the conversation, having dialogue, having education behind it, I think is fantastic. And the platforms like Robinhood, even though they might not be perfect at all times, and we all, you know, sort of sat through some of the testimony recently as far as should we regulate, shouldn't we regulate? And I believe in a free market. I think it's absolutely appropriate to be able to short stocks and take the pains that go with it, to go long stocks and take the pains that go with it if things reverse. What we want to make sure is we've got liquidity, a reasonably fair playing field, if not a perfectly fair playing field. And I'm just completely excited that the younger generation, that the next generation is taking an interest in the stock market that my peers perhaps en masse didn't have the opportunity to do. So I'm rooting for them.
Excellent. So after our first couple of interviews last year, we try to do this about once a quarter. I had advisors start asking me who were active in the cover call space, you know, about you, your program, and what you do. And we've been through that before. But I also have advisors saying, hey, Jay, I'm thinking about starting to write covered calls on my book of business. And it seems to me that is a gargantuan task. So what is your advice to advisors besides look at an SMA or an ETF that can do it for you, but somebody who wants to do it themselves? What advice do you have to that financial advisor?
Sending this expedition to Mars was a gargantuan task. Writing covered calls is not anywhere in that stratosphere as far as intellectual capacity is concerned. And I teach financial advisors all the time about covered call writing, and I think it's a incredibly important tool. If a financial advisor has a book of business that caters to baby boomers, retirees, folks looking for some income, we generally utilize it as a risk mitigation technique, but the byproduct absolutely is cash flow. Even with the 10-year at 1.5 and skyrocketing from 0.5, that's still not enough for most financial planners to generate a 4% needed income stream in a distributive phase of financial planning. So my advice is always putting together a program that's systematic. It doesn't have to be as detailed and daily and involved as how we run it at Capital Wealth Planning. But remember, we don't do anything else. I mean, once a quarter, I come talk to you for 10 minutes. Other than that, you know, we're busy running a strategy. So for financial advisors that are introducing it into their practice, and I'm happy to help in any way possible to encourage that, it's a situation where you need to come up with a system. You want it to be rules-based, and you want it to be consistent. You can't start and stop, because then you can run into bad experiences. So a lot of times for financial advisors that do it themselves, looking at a 4 times a year quarterly covered call program is a very appropriate way to introduce it into a portion of your practice.
Excellent. I think it's gargantuan to try and implement it across a book. And for you, it's like riding a bicycle. So we had to do, Kevin, sometime as a show on how to go through that process. I think it would be very, very informative for the audience.
It's the only skill set I have, Jay. So feel free to book me anytime.
Well, you also have Twitter now.
Yeah. I put out 8 tweets. So hold your breath for the next one.
All right, let's wrap with this. So you guys are managing billions of dollars now. It is a very serious process that you go through, even though we're making light. What keeps Kevin Simpson up in the first quarter of 2021?
Well, without a doubt, it was the COVID-19 and the rollout of the inoculations and the vaccines and the ability not only for it to be effective, which is the most important thing, but also for it to be available. And here in Florida, where we live, we're certainly seeing people now who have gotten their second shots. It's happening. And it's not just a question of knowing one or two people that have had shots. Yesterday, my father in Pennsylvania got his second shot. Now, my mom's not scheduled to get hers until I think it's March 10th that she'll get her first. So there's still a little bit of a lottery, still a little bit of a work in progress as far as getting it out there. And they actually have to drive 2 hours to get her shot where his was in town. But I think the only real thing that was worrying me, first of all, I'm a portfolio manager, so I worry about everything all the time, 24/7, which is what you want in the PM. But the thing that I was most worried about was the COVID-19. I'm encouraged about how it's being distributed. I'm encouraged about how the vaccine is rolling out. We need it to work. We need it to work on the variances. We need it to come out much more quickly to younger people so that we can get back to normal quickly, because that to me is the most important story for 2021, not just for the first quarter, the first half, but for the entire year.
Excellent. Kevin, I appreciate you coming on the show. For podcast listeners, please visit capitalwealthplanning.com to learn more about Kevin's firm. We'll see you next quarter, Kevin.
Thank you, Jay. Have a great day. Be well, everyone.